Okay, so the dog of the week is Fluence Energy, as the stock is down about 50% today. Now, this is a stock that I have had on my radar for some time, as I wrote a monitor report on it back in July 2023 and noted in that report that generally Fluence is not a company which we would write an in-depth report on due to its lack of profitability. However, seeing the business is well capitalized with net cash of approximately $350 million, has grown revenue at a compound annual growth rate of 135% from 2019 to 2022, has improved margins, and is guiding towards positive adjusted EBITDA by Q4 of 2023. We believe it is a name to at least place on our watch list and monitor its path toward profit. So let's dig into the stock a little and see why it's down today. Need to stay here. So Fluence Energy, FLNC on the NASDAQ, currently trading at a price of $6.81, a $1.6 billion market cap. The company is a global market leader delivering intelligent energy storage and optimization software for renewables and storage. The company's solutions and operational services are helping to create a more resilient grid and unlock the full potential of renewable portfolios. Fluence Energy was formed in 2017 as a joint venture between two massive global energy companies, power producer AES, or AES on the New York Stock Exchange, and German energy equipment giant Siemens AG. Now, the stock is down 50% today, and this is due to the company reporting weak Q1 2025 results and lowering its full year 2025 guidance, despite reporting record backlog of $5.1 billion. So looking at these Q1 2025 results, which are driving the stock lower, revenue was down approximately 49% from the same quarter last year, primarily driven by the pronounced back-end nature of expected revenue for full year 2025 compared to the revenue distribution seen in full year 2024. So, clearly the business is contract driven and can be lumpy. So that's kind of what we're seeing here. Now, net loss was $57 million compared to a net loss of approximately $25.6 million for Q1 of 2024. The company is still in a net cash position with total cash of approximately $654 million. But in December of last year, the company issued about $400 million of 2.25% convertible senior notes due in 2030, which, given the company is still not profitable, we will likely see them continue to raise additional capital going forward. But, the real kicker here is that the company lowered its fiscal year 2025 guidance, lowering total revenue guidance to 3.1 to 3.7 billion from its prior guidance range of about 3.6 to 4.4 billion. And the $600 million reduction in revenue from the previous midpoint is primarily due to the timing of certain contracts in Australia that the company now expects to sign later this year. The company also is lowering its fiscal year 2025 adjusted EBITDA range to 70 to 100 million from its prior guidance of 160 to 200 million. And again, the decrease in adjusted EBITDA is primarily driven by lower expected revenue and lower expected gross margins on recently signed contracts. And I believe that this is due to competition. As management commented here, we have experienced customer-driven delays in signing certain contracts that, coupled with competitive pressures, result in the need to lower our fiscal year 2025 outlook. While these delays are disappointing, we continue to see a very robust utility-scale battery storage market globally and strong interest in our U.S. domestic content product offering, in particular, as evidenced by, they're quoting their record $5.1 billion backlog. Now, this is a company that I will continue to monitor. But, I like the space that it operates in, but it is still very early. The business is certainly struggling to work toward profitability. And obviously, its drop today makes it our dog of the week.
Yeah, well, you have a revenue drop like that, net losses and lowering guidance, and you're trading at high multiples relative to the underlying. It's not surprising to see that it can decimate a stock. And we talk about that all the time. One little setback in a company with premium valuations, and this is what you get. And this wasn't a little setback. It literally
exactly.
So, yeah.